All right. How are you, everyone? I hope you are doing great. Today, we want to look at capital deduction allowances. So, what I want to start by saying is the purpose of the capital deduction allowances. So, the purpose is basically to facilitate and to encourage investments, and investments of a capital nature. When we say investments of a capital nature, which means, there are capital expenditures like purchase of assets and such kind of stuff. Now, this is the purpose of capital deduction allowances. So how does it encourage investments? So it encourages investments, by offering tax incentives by way of by allowing certain expenditures to be charged against income, thereby reducing tax liability of businesses. Yeah, so basically this is why this is how it works. When you incur certain investment expenditure, then there's an amount, a percentage of what you have incurred that you're allowed to charge against your income. So let me say your income was 200,000, and you've made an investment, of a capital nature. So you have a capital investment of, let me say, of 100,000. So this is just an example of 100,000, and maybe the government will allow you 20% of this as an allowable expense. So the taxable income now, will not now be 200,000. So when you will be computing taxable income, so computation of taxable income, you will have reported income, which is 200,000. Then you less capital deduction allowance. So this allowance, in this case, this is hypothetical figure. So this is just for example, for the purposes of an example. So this is 20% of 100,000, which you invested is 20,000. So basically, what now you will pay as a tax, 100, not what you will pay, but what you will be taxed on. So your taxable income, will be, so taxable income will be 180,000. So this is how the incentive works. So basically, you get the amount of the allowance that is recognized or approved by the government, and then you use it to lessen your tax liability. So that is the purpose of capital deduction allowances. So they are basically meant to encourage investment. So without this kind of tax incentives, maybe businesses would not really feel inspired and motivated to invest. Investment is costly. There's cost of land, cost of machinery, cost of equipment, film production, software, computers, furniture, motor vehicles, tractors, lorries, printers. Capital expenditures are expensive. So without this, let me say you have a mining company, and the total amount of the capital expenditure, you can just imagine it will be huge. But they don't shy away from investment because they know they can use this incentive to lessen their tax liabilities. So that is how the tax incentive works. Now let me go to a deeper explanation. So I'll show you how the previous regime was, because there was an amendment to the Income Tax Act in 2020, which adjusted something. So just so that you appreciate the change, I will just take a brief time to show you how the previous regime operated. So basically, we used to have wear and tear, wear and tear allow, capital deduction allowance. Then we used to have industrial building allowance, or let me start with investment allowance. Investment allowance. Then there was industrial building allowance. This, let me write it in full: industrial building allowance. And then there was farm works deduction. Farm works deduction. So basically, wear and tear, there were 4 categories. There was class 1, there was class 2, there was class 3, there was class 4. So I remember class 1 was about 37.5%, 37.5%. This was 30%, no, 25%. This one was 12.5%. So this is how it used to work. So basically, let me bold this so that it can, sorry. That investment allowance, this, deduction, this. Okay, so what used to happen is that with this previous regime, you had to know, like if you are buying furniture, you had to know furniture qualifies in which class of wear and tear. If you bought a computer, you had to go and check that computer is in which class before you charge the percentage of tax incentive which is allowable, and so forth and so on. But with the current regime, which was an amendment of last year, so this is the previous regime. But with the current, so let me just italicize this. So, but now we have a current in a capital deduction allowance regime. So this current regime is not a 2-step process; it is a 1-step process. So this previous regime was a 2-step process. So this was a 2-step process. What do I mean by a 2-step process? So this current regime, just a minute ago, so this current regime is now 1-step process. So it is simplified 1-step process. So what I mean by a 2-step process is that in the previous regime, first you had to know the class where your equipment falls under, or the category where where your investment falls under. After knowing the category or the class is when now you apply the percentage which is allowable or chargeable against income. So by two-step process, what I mean is that first you had to identify the identify class stroke category. Okay. Class stroke category is when based on the class stroke categories, now you charge relevant tax allowance. So this was the previous regime. But with the current regime, you don't have to identify the class or category where your investment falls under, because everything is individualized. So this current regime is individualized. So, or itemized. What I mean by itemized is that almost every purchase item is specifically identified with the percentage of the allowance that is recognized. So let me say, if you have furniture, you will find in the list there's a mention of furniture, and they have put the rate that you should apply. But in this other previous regime, you have to first find out where does furniture fall under before you apply the rate. But in this one, there's an itemized list. So you just go through the itemized list and you apply it directly. There are no classes, there are no, complicated process. So this one, the government is trying to simplify the tax procedure and compliance. I think this is some very good step, a step in the right direction. All right, so I want us to go straight to the act. So let me stop sharing this. Then I go and share the act straight away. Share your screen. Then I do this. Then I do this, and then I come here. Okay, if you can see my screen, this is a website of Kenya Revenue Authority. So the Kenya Revenue Authority, this is tax incentives. I've picked up capital deduction allowances, which are tax incentives generally. So the Tax Laws Amendment Act, which was assented to on 25th April 2020, amends various tax legislations. So the second schedule, which dealt with capital allowances, has been repealed and replaced with the new second schedule titled Investment Allowance. So you remember, even the title of this topic is called Capital Deduction Allowance. But with the current law, the current piece of legislation, we should not even call it Capital Deduction Allowances. We should just call it simply Investment Allowance. So Capital Deduction Allowance is a lingo which relates to the previous regime. Now, so the details are like this. I'll not read word by word, but the details are like this. If you look at capital expenditure, so just like I was telling you that this investment allowance or incentive is basically applying to capital expenditure, which means expenditure of capital nature, not revenue expenditure. For those of us who've done accounting, we know this: capital expenditure and revenue expenditure. Revenue expenditure are expenditures that are chargeable on the income tax. Yeah, like maybe salaries, stationery, rent. Those are revenue expenditures. But capital expenditures are expenditures mainly that go towards purchase of assets and long-term Yeah, long-term assets which have future economic benefits. Now, as you can see, we have hotel buildings. The rate is given 50% in the first year of use. Buildings used for manufacture, the rate is given straight away, so you don't have to peruse buildings and buildings used for manufacture. Hospital buildings, 50% in the first year. Petroleum or gas storage facilities. So for those who are in the petroleum industry, if you invest in a storage facility, 50% of the cost is chargeable against your income, and that is how big incentives. You will be reducing your tax liability hugely. Now you might be wondering what happens to the rest, because this one says 50% in the first year of use. So what about the second year of use? What about the third year of use? What about the fourth year of use? So that is why we come here and it says residual value to be charged 25% per year on reducing balance. So let me just enlarge it. So residual value for item A1 to A4. So from here, hotel buildings to petroleum or gas storage facilities, subsequent years are charged 25% on reducing balance based on residual value. And then there are other items. So I just want to use hotel buildings to illustrate how this thing works out. All right, so let me stop this and then I go to my Excel. I go to my Excel. Let me go to my Excel, just a minute. Excel, where are you? Excel is here. All right, so let us see how it works. So let me say that Unga Limited, no, let me say that Utalii Hotel has built a branch in Lamu, which they started using in 2020, January. Okay, so Utalii Hotel has built some hotel building, a branch. So this branch is hotel building, has built a branch. So this branch is hotel building. Hotel building. So this hotel building in Lamu, which they started to use in 2020 January. So you remember the law says that in the first year of use, not in the first year of completion. So applicable. So tax incentive, let me call it by its right name, investment allowance. Investment allowance is applicable. Allowance is applicable in the first year of use. Yeah, not first year of completion. So these nitty-gritties you must always be careful about, because sometimes you'll be told a building was completed in 2018 but was used in 2020, and then maybe you'd be tempted to start calculating investment allowance from the time that it was completed, while the law says that you should start calculating investment allowance in the first year of use. So let's assume that in the year 2020, the net income of Utalii was, let me say, 900,000. 900,000. So this was the net income of Utalii after charging depreciation of 50,000. So after charging depreciation of 50,000, and an amount of 20,000 was erroneously omitted from the net income. An amount of 20,000 relating to sales or relating to an income stream was erroneously omitted. So you are required to calculate or to calculate the taxable income of Italy for the year ended 2020. So this is the thing that you are supposed to do, and this is how you'll go about it. Now let's go through it once more. Italy Hotel has built a branch, some hotel building in Lamu, which they started using in 2020 January. Investment allowance is applicable in the first year of use. So this is an aside. So this is not part of the information you're given because you are expected to know this information by heart. Now in the year 2020, the net income of Italy was 900,000 after charging depreciation of 50,000. An amount of 20K relating to an income stream was erroneously omitted from the net income. So we are required to calculate taxable income of Italy for the year ended 2020. So we'll start with reported net profit, because net profit as per accounting is not the same as tax profit. Accounting profit is not the same as tax profit. So this is fundamental in taxation. Many people who don't know taxation think that when you're given accounting profit, you will just apply tax. But it is not like that. Accounting profit is not the same as tax profit. So we first get accounting profit, then we adjust to tax profit. So reported net profit, which is accounting profit, is how much? 900,000, right? 900,000. So let me just put commas in this column so that it looks neat and tidy. Like that. Let me remove the decimals. So this is the reported net profit. So this is the accounting profit. So we don't just apply tax. The same things that we should adjust before applying tax. So we should add back these allowables. So the disallowables that I can okay, I'll come back to that later on. The disallowable here is depreciation, because the depreciation is not allowed for. Is not allowed to be charged against income by the government. So you'll add back depreciation. So you will write here depreciation expense. Add back the disallowables. Depreciation expense was 50,000. Unless allowable let me start with less non-taxable. No, I have not. Sorry, there's something I'm not done here. I've not done here very well. Apart from adding back disallowables, we also add back omitted incomes. So this one will be we add back this one, so it will be 20,000. So 20. So I think let me just put them in this column first, then I'll aggregate them here. This one, if the total add backs comes up to 70,000. and less allowable expenses. Less allowable expenses. So this one will be investment allowance. Investment allowance, for which we will have working one, like this. And then normally we add also, I mean, we less also non-taxable income. If this net profit included some non-taxable income, we would have left it here. So this one normally includes non-taxable income, because there's some non-taxable income. Let me say there was some dividends which was taxed at source, and so you should not tax them again here. Then we would remove them from the schedule so that we don't tax that income stream again. Yeah, but since there's no item of that sort, we just remove that line item. So let's go to working one now so that we can calculate investment allowance. So working one, we have here investment allowance. So basically, in the first year we use cost, and you remember according to the schedule by KRA, which you should master. So first year of use, so let me say cost of hotel building first. Cost was how much? Cost was Utali has built a branch in Lamu, which they started using in 2020 January. So I didn't mention the cost. So Utali has built a branch, hotel building costing 1 million. Let me just use 1 million, costing 1 million. 1 million. So when we come here, then since we know the cost now, the cost of the hotel building is 1 million. What about investment allowance? So investment allowance will be 50% of cost. 50% on cost. Yeah, this is year one. So 50% on cost will basically be 50% times 1 million, which will be 500,000. So the residual value of hotel building So by the residual value, I mean how much have we not subjected to investment deduction allowance? Going by the fact that the original cost was 1 million, but we have already utilized 500,000 out of that. So basically, residual value remaining is what remains after charging investment allowance. So this one will be the difference. So if I can use some function and I just do like this, and I know that the residual value is 500,000. But now when you come to less investment allowance, our investment allowance now is like this. So we less it like that, and then we will get taxable income. So taxable income will be this taxable income is coming to 470,000. You can see how our taxable income has greatly reduced because of this investment allowance. You can imagine we were to pay tax on 900,000, but now because of this investment allowance, we are paying tax on only 470,000. So probably our tax will be 30% of 470, which is I think less than 150,000, thereabout. So this is 2020. So what about 2021? So this is 2020. What about 2021? 2021. What about 2021? What will happen in 2021? We will have, let me just show you this quickly. 2021. So let me assume that for 2021, the net profit was 800,000. So this is an assumption, so don't beat me up that where have you gotten this figure? This figure is some hypothetical figure for illustration purposes. So let me remove the decimals, and let me assume that there's no depreciation. Let me assume that there are no omitted incomes, but you have the investment allowance you have not fully utilized. So if you can remember our list from Kenya Revenue Authority, it was 25% on the residue on a reducing balance. So now we will have here working two. So let me just call this working two. So let me call this working two. Working two like this. I'll put it this side. It should have been this side, but anyway, I can just put it this side. Let me just put it this side. Let me just put it this side. Working two. So our working two for investment allowance will be like this. So we go to our schedules here. Residual value is what we're going to work with now, because it is 25% now on the residual value. So for 2020, for 2022, we will have, let me just put this here. We'll have working two here. Working two. We'll have residual value brought forward. Residual value put forward is 500,000, which is 500,000. Then investment allowance. Investment allowance now will be 25% on residual value on a reducing balance. 5% on residual value. Residual value. This one will be 0.25 times this. Let me put it in negative. It will be 125, and therefore I will have here residual value carried forward. So residual value carried forward. So this one will be, it will be the difference. So this one will be like this, and then you'll have 375,000. So when you come to our tax calculations for year two, our investment allowance now will be 125,000. It is, this 25% is not on 1 million, but on the residual value. I hope I have explained that clearly. So we will have here 125,000 as the investment allowance. So this one would be 125,000. And what you'll get here is the difference. So what you'll get here will be, what you'll get here will be sum of this and this. So this one will be 675,000. So what about year 3? Then we wind it up. Year 3, the 25% will still apply because the 50% applies only in the first year. So working B, working 3, we will have residual value brought forward, which is 375,000. Then we will have investment allowance on residual value. This one will be 0.25 times that, which is 93,000. So as you can see, residual value carried forward will be this into like this, 68,000. How come it can't be higher than, so this, I didn't do the negative, at 281. So the investment allowance for year 3, as you can see, is 93,000. This is what we mean by on reducing balance. If it was on a straight line, then the year 3 would have been 25% on cost. But since it is on a reducing balance, then the value keeps on reducing. Only the residue is what is charged. From the English word residue is where we get residual value. So when you come here, our investment allowance for year 3 will be 93,750. This one will be 93,750. And it goes on and on and on and on until it is exhausted, until it is zero, so that you don't apply investment allowance again. So this is how we deal with investment allowances. So you basically go to the schedule, apply it straight. You don't have to second guess. Looking at the categories, it is, the list is itemized. So you just apply the schedule, you check the percentage, you know how to calculate, and then you know how this one will now affect the tax liability. Because we less this, we subtract this investment allowances in finding taxable income. So let me wrap this up. Let me go to the screen again that we are discussing today. Yeah. So I hope you can see the screen now. Yeah, so this is how it works. So there are other categories. Educational buildings is 10% per year on reducing balance. So which means if the building was 1 million, then in 2020 you will charge 10% of 1 million, which is 100,000. In year 2, you will charge 10% on 900,000, which is 1 million minus what you already charged. Commercial building, the same. And then the next category is machinery. So we finished with buildings. Machinery, you'll get 50% in the first year of use. Hospital equipment, 50% in the first year of use. Ships, 50 in the first year of use. Then the residual value. Now, what remains after you've charged the 50%? Here they've said 25% in the first year of use, but there is an error here. It can't be that residual value also is charged in the first year of use. So that's why I put the PwC, PricewaterhouseCoopers analysis also, because this one Kerry didn't get it very rightly. So if you can look at this machinery, where's machinery? Yes, machinery like hospital equipment, ships. 50% in the first year of use, just like Kere is saying here, 50% in the first year of use for the machineries, but 25% per year afterwards on reducing balance for the residual value. So afterwards it is to 25%. So this one should not be 25% in the first year of use. It should be 25%. I mean here, the residual value should be 25% in the subsequent years on residual value on reducing balance. Then motor vehicle, 25% in the first year of use, and these people just end there. But if you look at PWC motor vehicle, you will find that it is 25% on a reducing balance. So for motor vehicle and computers, you will apply 25% in the first year of use constantly. You will apply 25% constantly, but on a reducing balance. But this statement gives the impression that you will only charge this in the first year of use only. But if you look at the correct point of view, you will charge this 25% in the first year of use, and in the subsequent years also it will be a constant rate of 25%, but on reducing balance. The same with computers. Furniture is very clear, 10% reducing balance. Telecommunications equipment, 10% per year reducing balance. Filming equipment to support the film industry. Machinery used to undertake operations under a prospecting right. Then machinery used to undertake, mining, like the tool in Turkana. Then other machinery that does not fall under these categories. Then purchase or an acquisition of an indefeasible right to use fiber optic, and then farm works, like irrigation schemes, like yeah, such kind of things. Greenhouses, 50% in the first year of use and 25% later on reducing balance. So this is how investment allowances work. I have now refrained from using the term capital deduction allowances because the amendment in the Income Tax Act now has done away with the term capital deduction allowances and instead has used the term investment allowances. As you can see, I have made comparison between the previous regime and the current regime. The previous regime was a two-step process. You had to know the class, you had to know the category. But in this current regime, it is a one-step process. Every item is individualized. You just go straight, you find the rate and you apply. And when you get the rate, it is an allowable. So you less it to arrive at your tax liability. So basically, this is what investment allowances are all about. I hope you've enjoyed the class. Thank you.